Hello, everybody, and welcome to this month's episode of Elevánt Insights. We are super excited to have you here, and mostly because we have just an awesome guest here with us today. Today, we've got Brie Williams with State Street Investment Management with us, and we're going to talk all things market, but probably in a little bit of a different way than you'd expect. We're not going to dive into the weeds of all of the macroeconomic or microeconomic impacts of tariffs and all these things that are going on. We're going to talk about things that are in our control, the things that we can control in reference to how we intake the market noise that's going on right now. So we're very excited about that. Before we jump into that, I wanted to do just a quick announcement, and so I'm going to share my screen really quick, and hopefully this pops up. So we have a couple of ways that you can access our old Elevánt Insights episodes from the past. And so I just wasn't sure if anybody had known that this was out there. A couple different places. If you go to events on our website, there's this Elevánt Insights tab here where you can actually go to historical Elevánt Insight episodes from the past, and you can click Watch Now. But that really is just linking you when you click Watch Now to our YouTube channel. So we actually have a YouTube channel now. So right up here on the top, you can click here to go to our YouTube channel, and that will take you there as well. And so I'm not sure if you can see that YouTube channel. I don't think you can, but I would invite you to check it out. If you want to subscribe to the YouTube channel, we're putting out videos that are just really there for your benefit. And so these Elevánt Insights, as well as some educational videos and things like that. So we probably promise we won't bombard you with videos, but hopefully that can be a great value add to you. So so as we jump into this month's Elevánt Insights, I want to introduce our guest. So Brie is somebody I've had the opportunity to interact with over the years in a couple different settings, and she is the head of advisory solutions and wealth intelligence at State Street Global Advisors. State Street, I can't ever keep track. I want to say they're the fourth largest. Is that right, Brie?
Correct.
Asset manager in the world, going up into the trillions of dollars that they're managing for people worldwide. And so State Street is super solid, and Brie is just integral to what they do. And we're excited to have her. And so, as a seasoned financial services executive, she has over 2 decades of experience navigating volatile markets through data-driven insights and strategic advisory solutions. A couple of other lines here. As a managing director at State Street Investment, she leads efforts to transform market complexity into actionable guidance that drives sustainable growth. So again, kind of taking the noise of a portfolio manager, maybe the way they would speak to us in the complexities of the markets, and trying to deduce it down to what are some actionable insights that we can use to drive income, to drive outcomes. And so that's why we're super excited to have her here. So Brie, thank you for being on the call with us today.
Well, it's absolutely my pleasure, and I appreciate the opportunity to speak with your clients.
Yeah, you bet. So I think we want to start with just this general idea that the markets are a little crazy right now. I think that's kind of a minimal way to say that, and a nice way to say it. There's just a lot going on, with the change of the tide with regards to the political environment, as well as the major changes happening with tariffs, the highlights on interest rates, and we've got some geopolitical things going on. So as we kind of look at that, what are you seeing in the data specifically that might help our clients make sense of today's uncertainty?
Sure. So I think your description is pretty accurate. And what stands out right now for us is it's not just about what's happening in the market, but it's really about how are you as an investor feeling about it? Because those feelings matter. They shape our decisions pretty powerfully, and often more so than we realize. So if you just kind of think about the last 5 years, it's been anything but steady. 5 years ago, we were talking 2020, and that was the height of the global pandemic. And that was a pretty wild ride. And then you look at 2022, which was not fantastic. So, when COVID hit, we had just come off of a 10-year bull market run. So it was pretty sunshine and flowers when I think about the market environment, and we were feeling pretty good, very optimistic as investors as it relates to that. So when COVID came in and the 2020s took off, that crash, we saw sharp rebounds, we had rising inflation, we had volatility, we had the political division going on in the US. There was a lot happening. As we think about more of the here and now, we see this cautious return to optimism. And, I think that's a positive for all of us because we're feeling a little bit better. That doesn't take away some of the concerns and maybe even negativity we may still feel about what's happening, particularly if, we're reacting to a headline, a talking head, what a neighbor has to say. Those are all factors. But the sentiment's beginning to come back around. But what I would caution us is just because we feel a little bit better does not mean all of us are doubling down and there's widespread action and everyone's jumping in and buying, when the market goes down or buying at the dip. And we're not promoting a behavior one way or the other, just putting some context out there as to what we see in terms of investor behavior and sentiment on the markets. What I am really encouraged by in the data when I think about looking at you and I as individual investors is this cautious optimism means we're taking a moment to actually think through, is it the right time for me to take any action, if at all, as it relates to my plans? So we're not just going in guns a-blazing when there's a dip in the market. So I think the touchstone we have on a plan, as well as just taking a beat to make a choice, is what really can help us keep us grounded with all the noise.
That makes a lot of sense. I go ahead, Dan. Sorry.
I was just going to interject a question, and you kind of partially covered it.
Mm-hmm.
But that question being, why does the mindset, and I guess more importantly, how does the mindset of the investors affect their behavior in the marketplace?
A really thoughtful question. So if we think about the headlines right now, they're a mix of cooling inflation data, uncertainty around interest rates, there's ongoing geopolitical tensions. All of those factors and more shape our sentiment about the markets. And where that mindset comes into play is, how are you processing that information? Because the way I may internalize those headlines could be different than the way the two of you internalize those headlines. So I think about our mindset as a way we shape how information is processed, how we assess risk, and how we make decisions. A really simple analogy as to how you think about the way you look at the world is, do you see the glass half full or do you see the glass as half empty? Now, whether you see it as full or empty, just be clear, your mindset is not this static state. So you have the ability to change over time. So it doesn't determine your behavior. Just because you see the glass as half empty today doesn't mean a month from now you're not going to see it through a more optimistic lens. So I think it's about not, again, good or bad, but just recognizing, where do you tend to fall when you think about the way you approach decision making, because your mindset is shaping the information processing and your assessment with risk and opportunity.
So when it comes to biases that are kind of formed from our own internal mindsets, I often think about confirmation bias, where confirmation bias is where, because we've experienced something a certain way, we believe it will continue to be that way into the future. And so we've had this experience in the last 10 to 15 years of a relatively steady bull run, outside of 2020 with COVID, and 2022 came down a little bit. But generally speaking, as you've dove into biases that we create, which biases really show up the most with investors?
Sure. So I can geek out on biases all day long, but we'll be reasonable on answering this question. First and foremost, we all have bias, and I don't want anyone thinking about bias as a flaw. It's just how your brain is wired. So they consistently show up in our patterns of research. And what you can do is just simply become more self-aware of the biases. And there are several that tend to rise to the top as being more common or frequent when we think about financial decision making. You were correct. Confirmation bias is out there pretty loudly. And what that is we tend to seek out information and trust that information that we seek out because it's likely supporting something we already believe. So this is where the aha moment and confirmation bias matters. Every time we click, scroll, like on social media, it's training the feed to serve you more of that same content. So without realizing what happens in a confirmation bias environment, just we could end up in this echo chamber. And rather than kind of stress testing or getting objective information or even a different point of view, we get more of the same. So our views are not being challenged.
Just feeding our own confirmation bias.
Exactly. And one way to counter that is you just kind of whittle down, like, who are your trusted sources? So clearly that should be the advisory team. It should be well-vetted research versus, a quick Survey Monkey poll. It should also be reputable financial media. Now, again, keep in mind, financial media's job or any news cycle is about getting eyeballs on the screen, getting those clicks. So sensationalism sells. When you're talking about finance or you're talking about the world of entertainment, they want to get the eyeballs. So just keep that in mind, because even if you're watching, CNBC and the closed program, you're going to still have a credible source, but they are leaning into what's hot. So confirmation bias is really loud. Particularly when I think about market volatility. The other bias that I think deserves some attention is availability bias. So availability bias is when we give more weight to information that's really easy for us to recall, often because it's recent or it's very vivid in our minds. We see it on repeat. So what's a good example of that today? I think in the headlines, there's still a lot of talk about recession. So it can feel like there's one right around the corner. The market data may not prove that to be true, but if you're just taking the headlines at face value, and that's all they're talking about, it will lead you to believe that this is a certainty soon. So the way to counter that bias of availability bias is you play devil's advocate. So what can you think about, and you can do this in partnership with the two of you, and you've got your clients can get on the phone and chat and talk about what are the alternative options that we should be thinking through. What about those underlying facts that we perhaps aren't paying attention to because they're not in the headline, or it's not something that I recently stumbled over. So you can take that decision, twist the lens, and now see it a little bit more impartially.
That makes
Brie,
a lot of
you kind of gone over those two biases specifically. Is there some guidelines that you would give us in general that would help us from making decisions financially that are harmful to our financial position? Or I guess maybe another way to state that, are there ways to avoid getting trapped in those biases?
Sure. So in general, you can't turn the bias off, but you can notice them. Again, take that pause and make decisions with your plan in mind. So it can be, so if you drew a picture of a circle, and then you filled that circle with all the noise from the different sources, and then you drew a circle for your plan, that circle is probably going to be much smaller because it's all about you, right? It doesn't affect the rest of the world or what's happening. Those are contributors to the success of your plan, but they're not the ultimate factors that can help you get to achieve those goals within that plan. So you want to pay attention to the small dot, you and your plan, because that is your North Star. And that's what should lead the way when you make choices. It doesn't mean, again, that you're not going to feel the pull of availability bias or confirmation bias. You will, but it is gaining that greater self-awareness to see where you tend to naturally lean, and then use some of those techniques to avoid a decision that can take you off track, or worse, have a negative impact on your assets for 2025. Because investing is a journey. So you want to be thinking long-term. You certainly do have immediate needs for your money, but when you think through what is really happening and is an action necessary, and having that conversation with the advisory team, that can give you the context you need as to whether an adjustment's necessary, or taking no action at all is actually the more prudent opportunity.
So when it comes to our own emotional behavior, and it's funny, we don't often do what's best for us, even though we know it's what's best for us. And so, there's this commonly shown picture out there that I'm going to share on the screen here that I'm sure you've seen before,
Oh,
it's
yeah.
by Carl Richards, and it's this idea that greed buy, fear sell, repeat until broke. So we know that this is wrong. We know that this isn't the right way to go about
Yep.
it. But we also see inflows and outflows from all major mutual funds and ETFs and index funds that suggest that this is what we do as humans and as Americans. We tend to do this kind of stuff. If we're taking a contrarian view and saying, hey, I want to flip the script, I want to buy low, buy the dip, and sell high, I imagine there can be some traps in our thinking that way as well in our efforts to try to buy the low. So what's some of the research that you guys see with market downturns and
Mhm.
why buying the dip may not be as common as maybe the media narrative would have us believe.
Agreed. And I love the illustration. It's well known. And another way I think to describe that is this is FOMO in action. So
Yeah.
fear. And you're correct. When we did some recent research among investors like you, we were interested in understanding, are we walking the talk in terms of what the industry thinks we're doing as individual investors, which is rushing into a buy the dip opportunity when markets go down? Or is there something else going on? And our research actually shows some good behavior. So we do see the downturns as opportunities, but in terms of all of us rushing in to buy, it's not true. Only about a third of the US population, when I think about individual investors, actually bought the dip. So it's not about awareness. We are aware that there are opportunities when markets go up and down, and they present different opportunities depending on where we are on our financial journey and what that market cycle means for us. But it does come down to how we perceive risk, how confident we are at that time, the access to capital to put that money to work if desired, and in many cases, just discipline. Again, discipline to do the right thing. Again, coached with your financial advisor on what's the right thing for you versus what's the right thing for your neighbor, because they're probably different answers. So I think rather than falling into FOMO, which is a challenging one to try and stay away from, I'm getting encouraged by the patterns of investor behavior that we recently saw. It's a healthy sign that we're making progress towards what I refer to as you're being more intentional in how you invest, and waiting and knowing when to act. It sounds pretty easy, but in practice, it's much more difficult to maintain because volatility, it can really test your patience, it can test your confidence. And that's why, having a very clear plan with your outcomes in mind for your financial life is really important. And having that discipline and taking a beat will allow you to stay outside of the FOMO circle.
I love that. And I really think about that discipline, the discipline to do what we know is best for us, despite the emotional pulls or the biases that are pulling us or triggering us in certain ways. From our experience, leaning on that financial plan and really keeping the conversation on the things you care the most about, we found that emotional triggers, when it comes to market movement, there's often an underlier there, right? There's something that's bringing some fear to the table. Maybe that they actually care about, right? Nobody really cares about tariffs or interest rates or, what's going on in the markets. They care, at least from our perspective and what we see, about what may be threatened by that movement, right? So maybe it's, can I still retire? Or can I still gift to my kids the way I hope to? Or can I still go on that trip or buy that car? And so keeping the conversation on the things they care the most about, and saying, hey, you can still go on that trip. We just may fund it a little differently than we were going to before, or we may adjust the timing a little bit, And so it often helps to kind of build that ability to weather the storm. So on that note, financial planning turning uncertainty into clarity. Do you find that, that's been our experience kind of looking at that, but does the data suggest that? Like from your perspective, are you seeing that, kind of focusing on a bigger goal or trying to put the market movement in perspective is a good way to go.
Thank you. So when you think about uncertainty in markets, it's a fact of life. It's going to happen. It's not going away. Despite all of our leading indicators, indices, and predictive modeling, uncertainty is a part of investing. So it's unavoidable. And what I would also say is something that you had mentioned just a moment ago is this is a journey and we will make some mistakes. So it's not about being perfect, but it's about trying to make smaller mistakes so we can resiliently come back from it and continue to be on track, because staying on track is not going to be a straight line. It is about, an ebb and a flow. Your life and your financial priorities also don't stay in a straight line. There are curveballs. There are opportunities you want to take advantage of. There's reprioritization. There's life change. So your plan is built to be fluid, but you have enough of a map that you have a path for you that's going to give you the autonomy you need to make more resilient decisions in the face of uncertainty. So I like to think about the plan as a map, but it's an interactive one because your plan isn't static, nor does your decision-making static. So you need to adapt in real time. So does the plan. And you, more importantly, want to have backup routes. In my house, we call that, what's the CYA plan? Cover your beep, So we have plan Bs. And I hope I don't have to use the plan B, but at least I've thought through the what if possibility. So in my mind already, I'm okay, I'll just move this over to column B and reprioritize this up to number 1 because this is what's happening right now. And that gives me a greater sense of control because I've now created some flexibility, but it's still within the map of my plan. So whether the adjustment's a market shift, a life shift, or a combination thereof, I'm still able to work with the advisory team in a trusted environment, knowing that we've got this larger plan and a map of where the Williams household is going, yet I have the capability to modify for peace of mind or for financial need, because what's happening is beyond my control. And that makes me have a higher confidence in achieving financial security, which is really a great measuring tool for all of you to be guided by is what is your definition of financial security? And when you think about real goals, like you were listing earlier, retiring on time, reworking capital to start a business, taking that fantastic trip for the whole family, whatever it is, those are real, those are measurable, those are meaningful. And that's how you should think about, how am I doing on the plan when you sit down biannually, annually, or you just reach out and have a call with the advisor team.
Hey, Brian and Brie, I want to interject a question here, maybe for both of you. If Brie, you could start out and then Brian finish up. How does having a financial plan help guide the decisions that we make as individual investors?
Sure. So for me, the plan is an anchor. So it anchors me in what did I set out to accomplish, or my family, what did we set out to accomplish? The capital I began the journey with to help maximize that. But then also as life unfolds, opportunities to maybe put a little bit more in the 529. Or if it was a great year in terms of the career and we received a promotion, could I take a little bit off the top and redirect that to something else to achieve a goal a little bit earlier or expand the horizon of that particular goal? So the plan gives me continuity, flexibility, but it anchors me in opportunity because I have that clarity of what I wanted, but also the flexibility to reshape it. Without a plan, I feel a little bit more reactive. And I think that's why I call it an anchor, because then I'm relying on a little bit more gut, how I feel that day in particular, or the whims, wherever it may take me, and how confident, or if I'm feeling particularly aggressive about risk that week, that month. and I'm going to deviate, and I may not get where I'm going as fast as I want to or as successfully as I want to, or could find myself having to catch up, which can detract from something else I wanted to do. So the plan is my anchor, and that makes a big difference.
Yeah, I agree with that. I like the idea or the word anchor. I think that's a really powerful word to use. The other thing that I really think about when I think about planning and the value of it in reference to financial decision making, I actually think about my kids a little bit. So I have a couple kids that when they feel like they're in a situation where they've lost control, whether it's, they're in trouble and we're coming down on them as parents and they're starting to lose control of the situation, or even just something as simple as, trying to manipulate a puzzle or a game or something, and they feel like it's kind of out of their control what's happening, they panic and they get almost emotional to the point of like you've got to try to console them, right? And so I almost imagine that we're that way in some ways as adults when we're dealing with financial decisions if we're focusing on what we cannot control. So to me, financial planning is kind of anchoring us, to use that word, back to the things we can control when it comes to the things we care the most about. And also to bring some reality to the situation, because often when we're thinking emotionally, we're doing it at 2 o'clock in the morning when we're not thinking straight and we're highly prone to an emotional mindset. Whereas if we can kind of douse those fears with a little bit of data and a little bit of reality when it comes to where we really are, we can put in perspective what that little dip is doing in reference to our broader picture. And I think most of the time, from at least from our experience from a planning perspective, most of the time what we're dealing with that feels so big is really not as big as it feels, right? And we can put it in its proper perspective, see that we're going to be okay, and if we aren't, we can see how we can pivot to make us okay, right? So hanging on to those things that we do have control over, and kind of bring back our emotional senses to quality decision making. So planning, I feel like it does more to provide true financial freedom where we feel in control of the chaos that's happening around us than just about anything I've ever seen. Diving into the chaos doesn't typically help from our perspective and from what we've seen. So
Agree with that, Brian. I think it's very well said. And a good way to think about the investment management part of the plan is the investment management's the engine that makes the plan you've put in place possible. And there are tools on the investment management side that you use: diversification, prioritizing quality of investments, downside protection, regular rebalancing, and so on, that keep your engine in great shape no matter what the market throws at you. So your plan is the hero, and that can drive the decision making as the guide versus the market.
Yeah. I love what you said earlier too, in reference to biases are normal, emotional triggers are normal, all of these ideas, all of these things that can be perceived as a negative reaction, they're very normal. So I can't remember if we said it in the actual conversation or if it was before we started going live, but congratulations, you're normal, I think is a comforting thing for everybody to hear. And that if we hang on to those things that we can control, anchor ourselves in our long-term plan, seek out good information from varying sources, and try to consume that from the perspective of our plan, it's going to give us a lot better chance to do that right thing, do that thing we know is right for our plan. So I feel like we could talk to you all day long, and I wish we could. But any final thoughts, any kind of advice or final thoughts that you'd have, just knowing all the things that you know about investor behavior and research and data and markets and all the things, any final thoughts that you'd have?
Sure. So I'd leave on a motivating concept, which is resilience. I find resilience motivating because it's not about a straight line. It's how you adapt in the face of challenge, any challenge. And you're not born being resilient, and you don't inherit this as a trait. It's a skill that you can build over time. So all the things we were touching on in this conversation of becoming more self-aware of the role that bias and emotion play in your decision making, and knowing that you have the ability to press pause, evaluate, have a conversation with Dan and Brian. Use those tools, because you need to make space for emotion, because it's part of the decision-making process. It's not bad. It's just about channeling it as a force for good. But you are the hero in this journey, so make sure you don't lose sight of that. So when you can stay anchored in your goals, use that plan, use Dan and Brian, then you're going to be able to be more productive, more resilient, and get the guidance, perspective, the turn down the noise sounding board that you really need. So I find resilience to be motivating, because no matter how turbulent it is, it's going to allow me to put a bit of some constraints, some consistency, and rationality around what's happening. How does this really affect me? And what is the right thing to do if any action is required at all, which odds are usually it's not, outside of the conversation I'm having with you right now, which I feel a lot better.
Yeah. Well, and sometimes there is action to take, though. And I think sometimes we kind of go to the one extreme where we say, I'm supposed to weather the storm, weather the storm, weather the storm, and we don't consider that maybe we should make an adjustment. I do I think a lot about planning as um like a pilot, right? So a pilot is going to create a flight plan, right? And they're going to spend time on this. They're going to analyze what they think the weather's going to be and what they think the conditions will be and the weight of the airplane and the plane they're flying and all the different things. And they're going to create this plan. And then they're going to get in the air. And I would imagine, I'm not a pilot, but I have a few as clients and I've talked to them about this. I would imagine the quality of a pilot is not in the quality of their plan, of their flight plan. It's probably the ability for them to navigate or deviate from their flight plan effectively when confirming evidence suggests they should, right? In other words, we've got a storm brewing at 16,000 feet. Our plan was that we were going to fly at 16,000 feet. Um, Maybe we need to adjust that, right? And a good pilot will know when those adjustments need to be made. And I think that a financial plan is very helpful in helping us understand and know that. And then certainly having an advisor that is committed to financial planning that can help digest, the markets and the complexities of all those things to know when it makes sense to make a change and when it makes sense not to. I would imagine though, if you navigate those emotions time after time after time, your feeling of resilience would grow. Your ability to put things in its proper place and take things with a grain of salt when you hear things on the radio or on the TV, and that you become more and more resilient over time. Do you find that as well in the data?
Absolutely. Yeah. So you build, it's like a muscle. You
Yeah.
build it by continuing to use the techniques that help you become more resilient, and it will pay you dividends over time. Again, have grace with yourself. It's not a perfect journey. There'll be some side steps along the way. Learn from those. It makes you a better investor, strengthens your prudence, bolsters your confidence, work with advisors you trust, quality information. But most importantly, it's about staying engaged and curious. There's no bad question. You have the right to feel the way you feel. Just need to put it in context of, does this impact what I'm working towards? And if so, how? Because then that will give you the tools you need to make a healthy choice for you and your family.
I love it. Well, we are super grateful that you carved out some time for us. Brie has got to get on to bigger and better things, and so we're going to let you go. But thank you sincerely for your time and more importantly for your expertise. This speaks volumes to me that State Street would bring somebody to the table with the expertise that you have, that it's not just about markets and the complexities of that, but how do we translate that to people and human emotion and, the ups and downs that we experience as humans. So thank you for your expertise and for your time. Um, the To close out this episode of Elevánt Insights, we just want to say thank you for the trust that you've extended to us. We do not take that lightly. We do everything that we can to be as good as we can for you in researching and learning and growing and spending time with people like Brie Williams, right, at State Street to help us know what we can do to help you navigate the storms and the parties of life, right? And so so thank you for that. Dan, do you want to introduce next month's Elevánt Insights and finish us off?
Absolutely. So looking ahead, next month's Elevánt Insights will take place on September 15th at noon, 12 p.m. Our topic will be investing in real estate, basically the opportunities and outlooks with our friend Maddie D from Blue Rock. And also myself, I'd like to thank you again for being with us today. We do certainly value the opportunity to help you stay informed and empowered about your financial future. You know, if you have any questions that you would like to continue this conversation or others, please feel free to reach out and to contact us at Elevánt Wealth. We look forward to seeing you soon again on Elevánt Insights. Until then, take care and stay well.
Thanks, everybody.
Thank you. Have a good day.
You as well.